Welcome to this session on interest rate determination and factors affecting its fluctuation. So part of our broader course on economic environment and business strategy. So in this course, we are concerned with understanding how macroeconomic forces influence business decision making. One of the most critical of these forces is the interest rate, a key price in the economy that affects investment, consumption, saving, borrowing, and risk. So understanding how interest rates are determined and why they fluctuate across instruments, market, and time horizon is essential for making informed business and financial decisions. So whether you are a firm deciding on capital investment, or a bank managing liquidity, or a policymaker evaluating monetary policy and fiscal policy trade-off, interest rates are central to strategic choices. So in the previous session, we explored interest rate determination in the bond market. Today, we turn in the money market where central bank actions, liquidity preferences, and monetary transmission mechanism play a dominant role. So we begin with a demand for money, where we are going to distinguish between transaction and precautionary motive in the demand for money. Then we consider the supply side, mainly controlled by the central bank, and learn how changes in the supply of money affect interest rates to the changes in bond demand and prices. So after building that foundation, we move to the theories of interest rate determination, which explains why interest rates vary across different instruments and time horizons. So here we will explore the risk structure of interest rates. Then subsequently, we look at the role of credit rating agencies, both domestic and international, in shaping perception of credit risk and influencing the cost of borrowing. So by the end of this and next session, you will have a sharper understanding of how interest rates are shaped and how they influence business decisions and environment, and why they are critical variable in business strategy formulation. So let's begin by looking at the determination of rate of interest in the money markets. So in this session, I have two key objectives. One is the interest rate determination via the money market, and the second one is theories of interest rate determination. So let's begin with the first one, that is the interest rate determination through the money market. So here we talk about the supply and demand for money. So mainly we use the liquidity preference framework to understand the interest rate determination in the money market. So here to begin with, what we assume that there are only two assets in this economy, only two assets. One is bond, and the other one is money. So then what we see that in the previous session, we have seen bond market, the supply of bond and demand for bond. And in this money market, we talk about money demand and money supply. So what we are going to do here is that the total wealth in an economy can be put into total bonds and total money. So that is on the supply side. When we look at the bond supply plus money supply equal bond demand plus money demand. So in this case, suppose rearranging this one, that BS minus BD is going to be equal to MS minus MD. That is the case when the bond market is in equilibrium. If one of the market is in equilibrium, the other market is also going to be in equilibrium. If BS is equal to BD, then MS is going to be equal to MD. So that means if bond market is at equilibrium, then the money market is also at equilibrium. That means the interest rate that is determined in the bond market, that is going to be the rate of interest in the money market as well. So if we discuss bond market, that are more than sufficient. But what we are doing here is that by using the money market, also we can determine using that framework, the liquidity preference framework. By using that framework, also we can determine the rate of interest. So let us move further. So this is the supply side. So supply is mainly determined by the central bank of a country, because money is issued by central bank of that respective country. So money, it is determined mainly by central bank. So mostly the supply of money is interest inelastic, because this is exogenously determined by the policy maker, that is the central bank, based on the economic conditions of the economic conditions. The central bank decide how much money to be supplied in this economy. What should be the money supply? What is the money supply in this economy? So in that context, we can define that, infer that the money supply is interest inelastic. So now I'm showing you the demand for money. The demand for money is mainly made by households and firms. And the demand curve for money shows the quantity of money demanded at each interest rate. So you can see from here the figure, the demand curve is slopes downward from left to right. That means it shows a negative relationship between interest rate and quantity of money demanded. So you can see here is that when the rate of interest is R1, quantity of money demanded is Q1, and when the rate of interest is R2, this is R2, rate of interest falls to R2, the quantity demanded money increases to this Q2, from Q1 to Q2. So we will briefly explain why when the rate of interest increase, when the rate of interest falls, why the quantity of money demanded increases, and vice versa. What is the rationale behind, what is the theory behind such a relationship, that we will shortly explain. So in order to understand that, let us first start the why people demand money, why demand for money. So people, households and firms, they demand money mainly for to fulfill the transaction motive. So the need for cash to conduct regular personal and business transaction, that means to pay for goods and services. In other words, to meet the day-to-day transactions of life, we need money. So in other words, simply we can say that demand for money is emerging mainly for transaction purpose or transaction motive. So in addition, there is precautionary demand for money as well. So when you demand money, you keep money with you. The main portion that will be to meet your day-to-day expenses. But some portion of your money demand is the money held to cover unexpected expenses or emergencies, unforeseen contingencies of life, such as sudden health expenditure or any other unforeseen events. So normally when we define demand for money, we redefine this transaction demand for money by including the certain component and the uncertain component. So the first one which we discuss here, this one is certain transaction demand, that is the routine payments. And the second one, this one is the uncertain transaction demand. So that means here the broader definition of transaction demand for money is to meet the day-to-day transaction, routine payment, plus for meeting the precautionary needs. So in general, sometimes we use both. We combinedly call it as transaction demand, but it has certain component and uncertain component. So the demand for money is influenced by the income level. So higher income generally increases transaction demand for money. So if you have high income, then you need more money, because your your day-to-day transaction will be high. In order to finance that, you need to keep more money with you. And the second one is interest rate on bonds. Higher interest rates reduce the incentive to hold money. Why? because there is an opportunity cost of holding money. And just before that, let us make a distinction between money and bonds. So money is used for immediate transaction, but it doesn't earn rate of interest income. It doesn't earn interest. You know that very clearly. So in contrast to this, bonds earn interest income but are not readily usable for day-to-day transaction. So what you can see here is that when you are demanding money, there is an opportunity cost of holding money. The interest are foregone by not investing it in interest-bearing assets like bonds. So that means when you are demanding more and more money, and that means then you are foregoing, the opportunity cost is that you are foregoing interest income. So in this case, what you can see that when the rate of interest is very high, you have the opportunity cost of holding money is also very high, because the amount of interest income that you are foregoing is very high when the market rate of interest is very high. So what you can see that when the market rate of interest is very high, the people will keep the demand for money. They will reduce the transaction demand for money, because they know that if they use more money, they keep more money with them, instead of investing in bond, they are going to forego large amount of interest income. So in contrast to this, when the rate of interest is very low, households and firms, especially households, they will demand more money, because by investing in the bond market, they are going to get less return. So the opportunity cost of holding money is low. So that will motivate them to keep more money for funding their day-to-day transactions. So bringing this one about the equilibrium in the money market. So we have already seen the demand curve slopes downward from left to right. That means higher the rate of interest, the opportunity cost of holding money is very high, and people will demand a low amount of money. So similarly, or in contrast, when the rate of interest is very low, the opportunity cost of holding money is very low, then they will demand more money. So let us look at here. So you can see this is the demand curve, and this is the supply curve. Let us look at different scenario. So before that, you know that this is the equilibrium where the demand curve intersects with the supply curve. The rate of interest is 15, and the quantity demanded and supplied is 300 billion of money. For instance, here the equilibrium rate of interest is 15, but we are going to see that, for instance, the rate of interest 25 is not going to be the equilibrium rate of interest. And because the fact is that the demand and supply framework will start working here. So let us look at the case 1 here. Case 1 is the interest rate is very high. Consider, for example, the rate of interest is 25%. So at this point, what you can see that there is excess supply of money. So the demand for money at this point is 100. So you can see that this is the demand for money. So the supply of money is 300. So this much is the excess supply of money. So at high interest rates, which I already mentioned here, the opportunity cost of holding money is high. So people prefer to hold bonds instead of money. That is the reason point here. So when the interest rate is very high, people would prefer to demand more bond. That means that leads to lower money demand and an excess money supply. So the excess money supply is here, 200 billion is the excess money supply. But that money is already in the economy. People have to use it. It's already with the people. But at this rate of interest, if you assume the rate of interest is above this equilibrium rate of interest, they are not going to demand this money. Then what happened here is that then people use the excess cash, because they have now 200 excess cash. They buy bonds, increasing bond prices and causing interest rates to fall. You know that when demand for bond increases, its price increases. When its price increases, the rate of interest decline. The rate of interest fall. So as interest rates fall, money demand rises. Just look at the y-axis. You just gradually reduce the rate of interest. When you are reducing the rate of interest, what you can see that the money demand gradually start increasing. That means you are coming downward this way. You are moving along the demand curve like this, like this. You move here, and finally this will be equal to the equilibrium interest rate. And at this moment, you can see again we are back to the initial equilibrium position at point C, where the quantity of money demanded equals quantity of money supplied, and you can see that money demand equal money supply. Let us now look another case, the opposite case, polar opposite case, where interest rate is too low. Just for example, let us look at this position, that the equilibrium, the point of E, that is not an equilibrium position. So at this, the rate of interest, you can see that rate of interest is 5%. Rate of interest is here 5%, and the quantity demanded, money demand is 500. Money demand here is 500. Money supply is 300. So you can see that there is excess money demand here. So that means 200 is the excess money demand. So now you can follow the interpretation systematically using the logic that we discussed a few minutes ago. At the low interest rates, the opportunity cost of holding money is low. So people prefer to hold more money. So this leads to higher money demand and an excess demand for money. So people sell bonds to increase money holdings, causing bond prices to fall and interest rates to rise. So as interest rates rise, so you can see that gradually when people are demanding more and more money, that means they will be selling their bonds. When they are selling their bonds, then the price will decline. When they are selling their bonds, the price of bonds will decline. So that means the rate of interest will gradually start increasing. So the rate of interest will be increasing. That means the quantity of quantity demanded of money, that declines, because when the rate of interest increases, you know that the opportunity cost of demanding money or holding money increases. So instead of 500, that is the initial demand, they gradually start reducing the money demand, and finally they reach to this position. The quantity demanded decreases like that, rate of interest, because of the increase in rate of interest, finally the equilibrium position is going to be at C. So let's now see if there is what is the effects of an increase in the money supply. Assume that the central bank of the country increases money supply in the economy. Then that means there is more money in the economy. When more money in the economy, you might have seen that, you might have heard that, in order to reduce the rate of interest, central banks sometimes they increase money supply. When they are increasing money supply, what we often hear that the rate of interest declines. Why? What is the theoretical justification behind this relationship? Because we know that interest rate is not the reward for money, that is the reward for bond, because you know that money doesn't earn any interest income, right? So that is the case. We need to operate this diagram, this figure through the bond market. So now let us begin with our discussion that there is an increase in money supply by the central bank. So an increase in the money supply engineered by the central bank will shift the supply curve for money to the right. So you can see that the money supply curve is shifting rightwards. So then you can see that initially this is the initial excess supply of money, and the new equilibrium position is this one, B. From initial equilibrium position is A, then the subsequent equilibrium position is going to be B. B is the new equilibrium position. What you can see here is that the quantity of money demanded and supplied increases to this point, and the rate of interest declines from R0 to R1. So what is the rationale behind it? So at the initial interest rate R0, there is an excess supply of money when central bank increases money supply. So at this moment, when there are more increase in money supply, people are not willing to hold this additional money with the existing rate of interest. So to reduce their cash balance, they buy bonds. So suddenly they are getting more money on their hand, but they are not willing to demand that much. So then what they will do, that at this rate of interest, for example, the initial rate of interest, that the high rate of interest R0, people are not willing to hold this additional money. they will invest, they are willing to buy, they now start buying bonds. That means by then increasing the demand for bonds. Then you know that when the demand for bond increases, so when the demand for bond increases, that the increased bond demand would lead to increase in the bond price. An increase in bond price means you already know that the interest rates fall, right? So that means when the demand for bonds increases, the bond prices increases, then the interest rates fall. So that means when the interest rate fall, the opportunity cost of holding money declines, then the people will demand this demand all the additional money here, additional supply of money, but only at a reduced rate of interest. Now you can see that when the rate of interest is R1, then the people will demand all this money, that the increased money supply, this del M, that will be absorbed by the households, but that is at a low rate of interest. So this is the theoretical channel through which an increase in money supply lead to decline in the or fall in the rate of interest, that is through the bond market. So effects of an increase in money supply, we have already explained this one. So finally, this is the new equilibrium position where the increased demand for bond pushes up bond prices, which is equivalent to a fall in the interest rate. And at this point, money demand at the new rate of interest R1, the money demand equal to money supply and money market, restoring equilibrium in the money market. So having discussed how interest rate is determined in the money through the money market, let us now move to the second objective of this lecture. Having discussed how interest rate is determined through either through the bond market or through the money market, let us now discuss what are the sources and causes of fluctuations in interest rates across different types of debt instruments. So in order to motivate this discussion, I'm showing you a figure that shows the rate of interest movement since from 1920 to 2020. So from here, what here written here is that I have presented the rate of return, the yield to maturity for different types of bond. One is corporate AAA bonds, another is corporate BAA bonds, another one is US government long-term bonds, and the fourth one is state and local government bonds. So we have here shown two private bonds, the corporate bond. One is AAA rating, that means high ratings. Next one is a little bit a lower rating, BAA rating corporate bonds. Then we also have two government bonds here. One is by the US central government, US government, other one US state and local government bonds. So what you can see here is that this is of the same maturity having bond is showing a different rate of interest. So why do interest rates differ across instruments? Instrument means the bond which I showed here, time periods and countries. So from this, let us derive some key observations from this figure. One is credit risk matrix. So you can see from here that the corporate and the private bonds are need to pay high rate of interest as compared to government bonds. So that means credit risk matrix. Corporate BAA bonds consistently offer higher yields than AAA bonds or government securities. That means investors demand higher returns for lending riskier borrowers. Then issuer type affects rates. The municipal bonds have the lowest yield in many periods, even below government bonds. And here the reason is that tax advantages and lower default risk for local governments influence their interest rate. And time varying trends. So all yields spike around the early 1980s, then trend downward. So it reflects macroeconomic factors like inflation expectation and monetary policy. Then the fourth inference is, but that's not mainly from this figure, global comparison raise deeper Why might India's interest rate be 6%, the US 4%, and Afghanistan 20%? So it all depends on inflation outlook, central bank credibility, political risk, and economic structure. So I have a simple question to you. So if you were an investor, would you prefer a 10% yield from Afghan bonds or a 4% from US treasuries? What does your answer depend on? So you know that if you invest in Afghan bonds, you are going to get 10%, but from US you are going to get only 4%. So what is your answer? So what is your choice? It depends on the default risk as well. You know that sometimes there is a risk in Afghan bonds. Sometimes you won't get back the money that you invested. So in order to understand this structure of this interest rate movement across different instruments and time horizon, there are two broader theories of interest rate. One is called risk structure of interest rates, and the second one is term structure of interest rates. So let's start with the first one, the risk structure of interest rate. So then why bonds are risky? So actually based on the riskiness of bond, we see there is different bonds, different types of bonds yield different rate of interest. Why bonds are risky? One is interest rate risk. Interest rates may rise between the time a bond is purchased and the time it's sold, reducing the bond price. That is one risk. Second one is inflation risk. Inflation may turn out to be higher than expected, reducing the real return on holding the bond. And the third one, that is the major one, that is the main risk, that is called default risk. Default risk means here the issuer may not make the promised payments on time. Maybe the government or the corporation, the supplier of the bond, after issuing the bond, after selling the bond, they may not make the promised payment on time, and they won't return the principal amount also. So the probability that the issuer of the bond is unable or unwilling to make interest payments and pay off the face value is the default risk. And most of our discussion is focused on the default risk, and default risk is mainly the perceived default risk are measured by risk rating agencies. So credit rating agencies assess the financial strength of firms and other governments, thus help investors identify the company's level of risk and the ability to repay debts. There are three broad group of ratings by rating agencies. One is called bond rating, including treasury bills and the corporate bond and government bonds. And the second one is commercial paper rating, that is short term. The third one is sovereign rating, that is the rating the governments. So these are the credit rating agencies registered under Security and Exchange Board of India, CRISIL, ICRA, CARE, and Fitch India, IVRP, Brickwork ratings. These are the main credit rating agencies registered under SEBI. I'm just showing you a screenshot of one of the credit rating agency, CRISIL. You can read how do they define a business risk, financial risk, and what kind of ratings they do. So if you visit this website, you are going to get lots of insights about ratings and what are the methodology they use, what are the parameters they use. They don't expect everything they will make into the public, but most of the information whichever they can share, that all this information is available on their website. This about India ratings, Fitch Group, and about the international rating agencies, Moody's, S&P, and Fitch. These are the three major international rating agencies. For the criteria for ratings, you can see that actually they do ratings separated for banks, corporate, means for different sector or region, fund, infrastructure, sovereign means government rating, insurance, international public finance, etc. So I'm showing you some more screenshot from another rating agencies, S&P. and also from Moody's. So what we have seen here is that in this lecture, we have first discussed the rate of interest determination using the liquidity preference framework, that the demand for and supply of money. And subsequently, we started discussing the reason, the factors that explain, that causes the fluctuations in the rate of, the variation in the rate of interest between across different credit instruments and countries and time horizons. So at that time, we started discussing now the risk structure of rating, the risk structure of bond. So by using the credit rating agencies, and we already listed out some of the rating agencies. They not only rate firms and their financial instruments, they also do ratings of the government as well, which is called as sovereign ratings. So in the next session, we will continue this discussion. We will discuss more about the credit rating, what are the rating they give, and subsequently we talk more about their rating criteria and related aspects. Thank you for watching this session. See you in the next session. Thank you.